In this week's video, we'll review numerous historical cases to help us understand the key difference between capturing big gains and big losses in the stock market. Clients and regular viewers may remember in late December 2016 in a video titled Annual Signal Last Seen Before 1982 Bull Run, we covered some very specific comparisons and similarities between the end of 2016 and 1982. We also covered similarities between the present day in an August 19th, 2016 video. And in order to help us better understand what volatility might look like in the years ahead, let's specifically look at the 1984 case. And if you know your market history, you know good things happen for a long period of time. In fact, the gain from November of 1984 into the spring of 2000 was 822% on the S&P 500. And we know from past videos that our goal in this type of market, or a market marked by strong trends, is to navigate between a point A and a point B that could be several years down the road. And we also know that many of the common missteps that could derail us between point A and point B are ultimately related to watching the markets too closely or having a short-term focus or short-term fear. Therefore, the more realistic understanding we have about normal volatility between a point A and a point B, the lower the probability of making these common missteps. And as we do in many of our videos, we'll be looking at a simplified case over a long period of time to illustrate basic concepts. And we know that over any long-term period in the markets, including this 3,873 trading day period on our screen, that we should expect normal volatility between a point A and a point B. But what is normal volatility? And how can it help us going forward? It may be difficult to believe during a period where the S&P 500 gained 822%, but 1,761 of the 3,873 trading days were actually down days in the stock market. And only 2,105 of the 3,873 ended up being green trading days. And in this window, we also had approximately 7 days that were flat. And the average loss on the 1,761 red trading days was roughly 0.67%. And the average gain on the 2,105 green trading days was basically the same, but in the opposite direction. It was a gain of 0.68%. What's the moral of the story here? Even during a very long-term secular bullish trend, and one that ended up gaining 822% between point A and point B, there's roughly a 50-50 split between green days and red days. 54% of the trading days were green, 46% of the trading days were red. And the magnitude of the gains and the losses was also basically split right down the middle, meaning it's very, very difficult to discern anything about the long-term trend or the long-term health of the stock market by looking at an individual red day, an individual green day, the magnitude of a red day, or the magnitude of a green day. And these stats tell us why it's so difficult to navigate between a point A and a point B. The feedback that you get on a daily basis is basically even. And as we've noted in videos in recent weeks and months, it's normal during a bullish trend to feel good, to feel bad, to feel good, to feel bad. And the closer we are to the markets and the more closely we watch our profit and loss, the easier it is to get distracted by these type of movements and normal volatility. If you're sitting on a lot of cash here at point A and you're waiting for a good entry point, there are numerous days where you get positive feedback. The market is red, it loses money, and it keeps telling you intermittently that you're right to be patient. And these stats also tell us how it's possible to look back years later and say, how did I not capture more of that 822% gain? Because when we get very, very close to the markets, it really looks like an even draw on a daily basis for the most part between the bulls and the bears. Let's look at another case. In a July 2017 video, where we asked what can we learn from these stock market fractals, we found numerous similarities between 2016 and calendar year 1995. So what did the volatility profile look like going forward from this point here? And specifically, we can look at another period that had this similar signal that had only occurred 10 other times in the past 35 years. It occurred on January 20th, 1995, giving us two reference points saying 1995 was similar to 2016. During this period, if we were watching the markets on a daily basis and looking at our account balances and our profit and loss on a daily basis, how easy would it have been to navigate between point A and point B? Said another way, how easy would it have been to capture a significant portion of the 228% gain that occurred between point A and point B? When we review the stats, the answer is it's not going to be very easy if we're watching things too closely. Out of the 1,306 trading days between point A and point B, 578 of them finished red. Out of the 1,306 trading days, 727 were green, and there was one flat day between point A and point B. How about the magnitude of the gains and the losses? Would that have helped us? Well, given the average loss on these 578 trading days was 0.74%, and the average gain on these 727 green trading days was 0.76%, it wouldn't really have helped at all. If we're watching things very, very closely from a percent of green days and red days perspective and a magnitude perspective, during the entire time from point A to point B, it will appear to be a relatively even draw between the bulls and the bears. If you're bearish during this period here, there's plenty of positive feedback that occurs between point A and point B telling you that you're right. And if you're overly concerned about losing money when you're long, there's plenty of red days and plenty of days with losses to get you distracted and get you out of the market prematurely. These stats help us understand why we use the expression 100% normal and to be expected volatility between a point A and a point B. We learn next to nothing about the health of the long-term trends in the stock market when we have a red day or when we have a green day. Let's look at one more bullish case and then let's compare those stats to a bearish case. We covered this chart here from 1954 to the end of 1972 in a November 2017 video with this title here. Over this 19-year period, the S&P 500 gained 376%. And this period covered 4,758 trading days, of which 2,137 were red days and 2,550 were green trading days. 71 of the 4,758 trading days were flat. The average loss, or the magnitude of the red day, was basically 0.5%, and on the 2,550 green days, as you might have guessed, it was basically the same, roughly 0.5%. Given the split between red and green of 54 to 46, and an even tug of war from a magnitude perspective, if we're watching things too closely, it would have been very, very difficult to navigate between point A and point B or capture a substantial portion of the 376% gain that occurred from 1954 to the end of 1972 in the S&P 500 index. When we see these stats, it's very, very easy to understand how these common missteps can lead to disappointing results. These stats tell us that on a daily basis, a weekly basis, and a monthly basis, things can be very, very even and confusing. Does the market's volatility profile change significantly when we enter a bear market? To help us answer that question, let's look at one of the periods that we want to avoid. Hence why the model's basic objective is to discern between volatility to ignore that occurs within the context of an already established and ongoing bullish trend, and volatility to respect that requires defensive action because now the odds have shifted and they favor a series of lower lows rather than a series of higher highs. If you know your market history, you know the stock market peaked in October of 2007 from the intraday high to the intraday low in March of 2009. The S&P 500 lost an eye-popping 57%. It'd be very, very difficult to classify a 57% hit to our hard-earned capital as volatility to ignore. How do the stats look over this 354 trading day period? 179 of the trading days were red, and 174 of the trading days between point A and point B were green. And this is how people look back from this point here and they say, how did I let myself lose 57%? The answer is because the market kept giving them positive feedback between point A and point B. Every time there was a green day, and that was 174 trading days out of the 354, it was very, very easy to convince yourself that the market was going to come back and that being patient was the right thing to do. How about from a magnitude perspective? Not really a dramatic difference here either. The average loss in the 179 trading days was 1.82%, and the average gain of the 174 trading days was 1.46%. Again, helping us understand how someone could look back and say, how did I let that happen? 49% of the trading days between point A and point B gave them a false sense of hope that being patient would pay off. And just as we know within the context of a bullish trend, we know that we're going to get normal and 100% to be expected counter trend moves. The same thing happens in a bear market. We get normal and 100% to be expected counter trend moves, counter trend moves, counter trend moves, counter trend moves. And these counter trend moves help explain how people stay invested between point A and point B. So as the stats will show us here, there's a fine line between volatility to ignore and volatility to respect. And getting that key component right can significantly impact our quality of life. We can see out of all of the cases that we've reviewed, the split between green days and red days is very, very similar. And on a daily basis, we will, for the most part, perceive it in all four cases as a 50-50 split, which makes it very, very difficult to discern psychologically between a bullish trend and a bearish trend. Even though the splits were very, very similar, the impact on our net worth and our portfolio was significantly different. In the first three cases, we get big gains between point A and point B. And in the fourth case, we get a big loss, a 57% hit to our hard-earned capital. And this is where our philosophy differs greatly from buy and hold and hope. If it's very, very difficult to discern between case A, B, C, and D by watching the markets on a daily basis, it's going to be very, very difficult for a buy and hold investor to avoid this type of loss. And in each case, If I started with $1 million, the outcomes can be significantly different. Sometimes buy and hold is sold as it'll all work out in the end. Look at the magnitude of the differences here. Even though the split between red and green days was very, very similar, in this case, my $1 million turns into $9 million. In this case, my million turns into $3 million. This case, the million grows to 4.7 million. And in this case, with a very, very similar psychological profile, my $1 million unbelievably turns into $430,000. And it would be very, very easy to understand how a buy and hold investor would look back from this point here and say, how did I let that happen? So what's the moral of the story here? It's very, very difficult to discern between these periods when we're watching things closely. If we use multiple time frames and multiple inputs and focus on the weight of the evidence, there are ways to discern between case A, B, and C and case D that produces significantly different outcomes. And if we compare the present day, does the present day look more like A, B, and C, or does it look more like D? In the August 19th, 2016 video, we used the 30, 40, and 50 week, for illustrative purposes only, moving averages. And you can see here, we get the bullish cross. This is the early stages here. So in the present day, have we lost that look? Is it starting to roll over, negating the similarity to 1984 and 1982? The answer is absolutely positively no. These are the exact same generic and for illustrative purposes only 30, 40, and 50 week simple weekly moving averages, and you can see we still have a full bore bullish look. This looks like a strong, sustainable trend and doesn't look anything like this concerning rollover look here. How long will this last? We have absolutely positively no idea, and we will continue to take it day by day. And as you can see from this chart here, taking it day by day has worked rather well, helping us stay with this long-term bullish trend. So does the present day still look like this case here? Yes. How about the similarity between 2016 and 1995? Have we lost this bullish breakout here in the present day? Is this now a failed bullish breakout? The answer is no. If we look at the exact same value line geometric index as of March 15th, 2018, you can see the long-term breakout, the fractal breakout that's very, very similar to the breakout that occurred in 1995 is still alive and well. We're well above this point of prior resistance, above this point of prior resistance, and above this point of prior resistance. How long will this breakout hold? We have absolutely positively no idea. The facts that we have in front of us today still align with the bullish fractal breakout that we covered in July of 2017. So by this measure here, the present day still looks like 1995, and we can check another yes box. So we're down to two periods here. Does the present day look more like 1954 to 1972, or more like the peaking process and bear market between 2007 and 2009? In the November 2017 video, we used, in this case, the generic and for illustrative purposes only simple 8-year and 9-year moving averages. You can see between point A and point B during the entire period. Blue, the fastest moving averages on top. For the most part, prices above the moving averages, and the slopes of both of the moving averages are positive. In the present day, and during the correction and pullback that we've had, have we lost this bullish look? The answer is no. We still have the bullish look. These are the exact same moving averages as of 2 o'clock on Friday, March 16th, 2018. price, if we put it on the chart, is still above. We have a full bore bullish look, and the S&P 500, despite the pullback year to date, is still up 78 points for the year, or almost 3%. So we don't have any evidence in hand that says the present day no longer looks like 1954 to 1972. Well, this is obviously the volatility that we want to avoid here. How does the present day compare to this period here, or case D? Well, since we cover these periods all the time, the peaking process in 1999 and 2000 and the peaking process in 2007, using in this case the simple 100-day moving average all the way out to the 290-day, meaning we're looking at trends on multiple time frames. And when we say generic and for illustrative purposes only, these are not the moving average pairs used by the market model, but they help us illustrate basic concepts. So given the recent weakness, is the present day starting to morph into a concerning look like this? At this point, the answer is absolutely positively no. We still have a full-bore bullish look as of 2:42 p.m. on Friday, March 16, 2018, with blue the fastest moving average on top. If we put price on this graph, it's above all of the moving averages, and the slopes of all of the moving averages are up. Is it possible that this morphs into something like this? Yes, it's possible. But we don't anticipate that or forecast that. We need to see it. And that's where the maximum flexibility comes in. We take it day by day. We're very flexible about what this chart might look like tomorrow. And at the same time, we can be very confident about what it looks like and what it's telling us about the probability of good things happening relative to the probability of bad things happening on Friday, March 16th, 2018. And respecting that we've checked a yes, a yes, a yes, and a no using relatively simple inputs on one time frame. Remember, the model uses multiple inputs on multiple time frames. In fact, the trend strength portion of the CCM market model, which is one of the sub-models, Kathy ran the score on Friday. It asks over 200 questions about the health of the S&P 500's trend on multiple time frames. The score on Friday, March 16th, during the trading day, was 100, telling us that the facts that we have in hand today still align with a sustainable and ongoing bullish trend in the stock market. That's not a forecast. It's simply a probabilistic statement based on the facts that we have in hand. If the look of the hard data starts to morph into something more concerning like this, then our assessment of the probabilities will change. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.